Okay, let's dive right into this explainer, because right now we're literally watching one of the most bizarre economic disconnects in modern history unfold. I mean, on one hand, Wall Street is popping champagne over soaring stock markets and record highs. But right on the exact same day, consumer sentiment for everyday folks on Main Street, it plummeted to its lowest level since they've even started keeping track back in 1952. We've got a government pumping $7 trillion into the economy, but only pulling in $5 trillion in revenue. Guys, this isn't just some tiny accounting glitch. We're talking about a fundamental shift in how money actually works. So you might be wondering, why is there such a massive gap between the stock market and our everyday reality? Well, the truth is, we've likely passed the point of no return. The old systems are groaning under incredible strain, making some sort of massive transition totally inevitable. What we're actually watching play out is a high-stakes, global race between two totally different concepts of money: infinite digital dollars in one corner and finite physical gold in the other. To help us map out where your wallet fits into this wild landscape, here's our roadmap for this explainer. 1. The AI debt paradox. 2. The Clarity Act master plan. 3. The risks to traditional banks. 4. The physical gold rebellion. And 5. The future of your money. Let's get right into it. Starting off with Section 1, the AI debt paradox and breaking the 230-year engine. So, for over 2 centuries, our economy relied on a very specific growth model. Think of it like a car engine, but fueled by a constantly growing human population. Under this human engine model, every generation is a bit bigger than the last, right? More workers naturally means more taxpayers, more borrowers, and more consumers. You could essentially always grow your way out of national debt just by feeding more humans into the machine. But here's the kicker. The AI engine model totally breaks this 230-year-old assumption. Artificial intelligence is literally the first technology in human history that can dramatically grow the economy and corporate profits without growing the need for human jobs. And if you aren't growing human jobs, you certainly aren't growing the tax base. And honestly, this quote perfectly hits the nail on the head regarding the massive macroeconomic paradox we're facing today. If AI truly is the game changer that the stock market valuations claim it is, it's going to displace a lot of jobs. But if you have fewer people working, you have fewer people paying taxes. It's that simple. The very foundation that actually funds the national debt, the foundation that allows the system to slowly inflate that debt away, just crumbles. There's just no version of reality where AI completely replaces human labor, and our old debt system just keeps humming along normally. Which brings us to Section 2, the Clarity Act master plan and the dollar's digital defense. This leads to a pretty massive pressing issue. With a shrinking taxpayer base here at home and foreign countries frankly buying fewer U.S. Treasury bonds, who on earth is going to buy the trillions of dollars in U.S. debt needed to keep the lights on? Well, the U.S. actually has a highly sophisticated plan to solve this, and it revolves around a proposed framework called the Clarity Act. The strategy here is to rebuild the entire global payment system on digital rails, using payment stablecoins. If you don't know, stablecoins are basically just digital dollars. What this act proposes is wild. It opens up the power of money creation to major corporations. Think Apple, Walmart, Amazon. Under this framework, these massive companies essentially become mini central banks, issuing their very own digital dollars. But here's the brilliant catch. Every single one of those corporate stablecoins has to be backed by U.S. Treasury debt. Let's break down exactly how this weaves into your everyday life. Step 1. A consumer anywhere in the world walks into a coffee shop and buys a latte using, say, an Apple Pay stablecoin or Walmart coin. Step 2. To issue that specific digital coin, the corporation is legally required to buy and hold a U.S. Treasury bond. And Step 3? That's the ultimate goal right there. The U.S. national debt gets quietly and indirectly funded. In this new future, you don't even need to be an American citizen or pay U.S. taxes. If you've got a smartphone and you're buying a cup of coffee using these digital rails, you are artificially creating demand for the U.S. dollar and funding the U.S. deficit. It is, quite frankly, a masterclass in embedding the dollar directly into the internet's infrastructure. All right, moving to Section 3, risks to traditional banks and the fight for deposits. Now, as you might guess, this digital master plan is creating some massive domestic friction. Not everyone in the U.S. is thrilled about this transition, especially the folks currently sitting at the very top of our traditional financial system. The battle lines are completely drawn. On one side, you've got crypto and digital innovators. On the other, traditional banking executives. Brian Armstrong, the CEO of Coinbase, pointed out that traditional banking heavyweights, like Jamie Dimon, are actively fighting this tooth and nail in Washington. And why wouldn't they? Banks make their money by holding your deposits. If the Clarity Act empowers major tech and retail giants to act like banks, the traditional banking industry completely loses its monopoly over the flow of capital. For you, the everyday investor, the choice is going to become blindingly obvious. Let's look at the numbers. Right now, a traditional big bank might pay you, a fraction of a percent? Say 0.1% interest on your hard-earned savings. But a corporate stablecoin, backed directly by U.S. Treasuries that yield much higher rates, could easily offer you a 4% yield or even higher just for holding their digital currency in your digital wallet on your phone. When everyday folks realize they're being strongly incentivized to yank their deposits out of traditional banks and move them into corporate stablecoins, we are going to witness one of the greatest migrations of wealth in banking history. Make no mistake, traditional banks are fighting for their absolute survival right now. Let's look at the global picture in Section 4, the physical gold rebellion and the global countermove. So while the U.S. is busy building this ultimate digital defense for the dollar, the international stage is telling a completely different story. Countries like China, Russia, and the broader BRICS alliance, they see exactly what this digital dollar strategy is. It's a way to export U.S. monetary influence to literally every smartphone on Earth. And they're actively routing around it by sprinting back to the physical world. To really grasp their countermove, we have to understand the massive illusion of the gold market. For decades, Western institutions essentially ran a three-card Monty Street hustle with gold. When you bought gold, you often just bought unallocated gold, which is basically a fancy piece of paper promising that a bank had your gold in a vault somewhere. Just look at this massive discrepancy. By 2021, the London market had an estimated $635 billion in paper gold claims, but they were sitting on top of only about $70 billion of actual physical gold. That is a 9-to-1 ratio. They literally created an unlimited paper supply of a finite physical asset, which artificially suppressed the real price of gold for decades. But guess what? That shell game came to a screeching halt. Pre-2021, this unlimited paper supply kept the hustle alive and well. But then, the Bank of International Settlements, which is basically the central bank for all central banks, stepped in. They implemented a rule change called Basel III. This effectively forced Western banks to fund their gold positions with real money, making that paper shell game way too expensive and risky to keep up. And the result of that? Well, by 2023, central banks around the entire world had pivoted. For the first time in modern history, they pushed physical gold above U.S. Treasury bonds as their #1 reserve asset. And absolutely nobody is taking advantage of this shift quite like China. Get this. In just one recent tracked year, China imported an astonishing 939 tons of physical gold. To put that massive number into perspective, the entire world only mines about 3,500 tons of gold in a whole year. China alone is pulling in over a quarter of the global mine supply. They're literally draining the real physical asset out of Western vaults, firmly positioning themselves for a future where global assets are going to be radically repriced. Finally, Section 5, the future of your money and navigating the uncertainty. So, what does this all mean for you, the everyday investor? Right now, the paths forward are clouded with some massive market uncertainties. I mean, we're seeing this huge pump of money flooding into the stock market. But you've got to ask yourself, is this genuine growth? Or are these rapid IPO pumps just acting as exit liquidity for early insiders before the music finally stops? We've also got looming global energy shortages that could seriously throttle this whole AI boom, plus the very real potential of pivoting toward a commodity supercycle, where real, tangible, physical goods absolutely skyrocket in value. This intense uncertainty is exactly why legendary investors like Warren Buffett are sitting on a record-breaking $400 billion in cash right now, rather than blindly buying into the current market euphoria. Ultimately, this entire explainer boils down to two fiercely competing theories of what our economic reality is going to be moving forward. The current dollar system, it's a world of infinite possibilities. It's a digital landscape where valuations can stretch forever, and debt can just be endlessly monetized through these new stablecoins. But on the flip side, physical assets like gold represent the world of the real. They are finite things with intrinsic limits, totally outside the control of tech algorithms and central bank policies. And right now, both of these sides are racing to control the future. And that brings us to the ultimate question you have to answer for yourself. As our traditional banking systems are threatened by higher-yielding corporate stablecoins and global superpowers are aggressively hoarding real-world assets, the landscape of wealth is undeniably shifting right beneath our feet. So, are you placing your confidence in the infinite promises of the digital dollar, or are you looking toward the finite security of physical assets? Which side of this unprecedented money race are you betting your financial future on? Thanks for joining me on this explainer, and keep questioning the systems around you.